A U.S. bank is insolvent right now, and nobody warned you. 3 days ago, an alarm went off in the American banking system. You didn't hear it. The financial media didn't cover it. Your banker didn't call. But on Tuesday, January 13th, 2026, at exactly 11:42 p.m. Eastern Time, a regulatory filing quietly hit the Federal Deposit Insurance Corporation's database. Not a press release, not an emergency notice, a quarterly call report. Buried deep inside that report on page 212 in a section labeled Schedule RCM Part 2 was a single number tied to a $91 billion regional bank based in Charlotte, North Carolina. Unrealized losses on securities and commercial real estate loans, $17.3 billion. According to the same filing, the bank's total equity capital was just $9.8 billion. Those are the numbers as reported. And taken together, they mean something simple and disturbing. On paper, that bank has a negative net worth. It is technically insolvent. The only reason it's still operating is because accounting rules allow losses to remain hidden as long as assets aren't sold. But here's the part that matters to you. If a bank this large can file numbers like that in the middle of the night without triggering public alarms, this isn't an isolated mistake. It's a signal, because this filing didn't create a crisis. It revealed one that's already moving. What happened in Charlotte isn't an accident. It's the visible edge of a much larger pattern that's been forming quietly for years. Fact. This bank didn't collapse because of reckless lending last quarter. The losses disclosed in that filing were built up over 36 months, accelerating sharply over the last 12. They came from two places: long-dated securities bought when interest rates were near zero, and commercial real estate loans tied to properties that no longer generate enough cash to survive. Here's the framing most people are missing. This isn't about bad decisions by one management team. It's about timing colliding with math. Fact. From March 2022 through late 2023, the Federal Reserve raised interest rates from roughly 0.25% to over 5%. That was the fastest and longest rate hiking cycle in 4 decades. When rates rise that fast, bond prices fall, and when bond prices fall, losses pile up, even if nobody wants to admit it yet. At the same time, commercial real estate didn't crash overnight. Office buildings emptied slowly. Retail traffic bled out over years. Loan delinquencies lagged behind reality. By the time they show up in reports, the damage is already locked in. Now, here's the question that reframes everything. If one bank's balance sheet can flip from healthy to insolvent without a single headline, how many others are already past that line? Because the Charlotte filing wasn't unusual. It was early, and this is where the story stops being about one bank and starts being about the system those banks are connected to. There's a claim that sounds extreme, but the documents back it up. Fact. The first modern bank failures of this cycle didn't start with bad loans. They started with losses no one wanted to look at. On March 10th, 2023, Silicon Valley Bank failed. 2 days later, Signature Bank followed. In total, more than $120 billion in assets were seized in less than a week. Those banks didn't implode because borrowers stopped paying. They collapsed because they were sitting on massive unrealized losses in treasury bonds and mortgage-backed securities purchased when interest rates were near zero. Fact, Silicon Valley Bank held roughly $120 billion in securities. When depositors began pulling money out, the bank was forced to sell $21 billion of those bonds. That sale locked in a loss of about $1.8 billion in a single move. The moment that loss became public, confidence evaporated. Deposits fled, the bank was gone. Notice what's missing from that story. No fraud, no exotic derivatives, no sudden recession, just math colliding with time. Now here's where this flips. That was March 2023. We are now in January 2026, and the problem that killed Silicon Valley Bank was the smaller, cleaner version of what's coming next. Because securities losses can stay hidden if you don't sell, commercial real estate losses can't. And that difference changes everything. What's happening now is an escalation, not a repeat. Fact. When a bank holds a treasury bond that's fallen in value, the bond still pays interest. It still matures at full value. The loss only becomes real if the bank is forced to sell. That's why 2023 was survivable for many institutions. They could stall, they could wait. Commercial real estate doesn't work that way. Fact. When a bank holds a loan on an office building that's now worth far less than the loan balance, and that building is half empty, the cash flow disappears. Borrowers stop paying. The bank doesn't wait for maturity. The loan defaults. The loss is permanent. This is where normalization becomes dangerous. Empty office floors, malls being torn down, apartment buildings offering months of free rent. These aren't headlines anymore. They're background noise. And that's exactly how systemic problems spread when abnormal conditions stop feeling urgent. Fact. Delinquency rates on office building loans held by banks rose from 0.4% in early 2023 to 4.8% by December 2025. That's more than a tenfold increase, and delinquency isn't the beginning of trouble. It's the point where trouble is already months old. Here's why this matters. Once a commercial real estate loan defaults, the bank doesn't just take a paper hit, it forecloses. It takes ownership of a property nobody wants. It sells at whatever price the market will accept, sometimes 40 cents on the dollar. That loss comes straight out of capital. And when capital runs out, banks don't get time. They get closed. This is the shift. From losses you can hide to losses you can't. Now the pressure starts stacking fast. Fact. As of late 2025, U.S. banks collectively hold about $3 trillion in commercial real estate loans. Office buildings alone account for roughly $626 billion of that total. According to economic research cited in the data, about 44% of those office loans are already in negative equity. That means the buildings are worth less than the debt attached to them. At the same time, retail properties are cracking. National retail vacancy rates have climbed past 14%. Older malls and strip centers are bleeding tenants. Banks are exposed to roughly $480 billion in retail commercial real estate, and even conservative estimates put tens of billions of that at risk. Then add multifamily. Fact. Delinquency rates on apartment building loans have doubled in just 2 years. Overbuilding, higher rates, and slowing rent growth are squeezing cash flow. These loans were supposed to be the safe category. They're not anymore. Here's the mini crisis. These problems aren't sequential. They're simultaneous. Office defaults rise, retail cash flow collapses, multifamily weakens. At the same time, banks are still sitting on hundreds of billions in unrealized losses on securities bought when rates were near zero. According to FDIC data, those unrealized losses exceed $600 billion. Now watch how fast this escalates. Losses eat into capital. Capital constraints trigger regulatory pressure. Regulatory pressure forces asset sales. Asset sales turn hidden losses into real ones. And all of this is happening before the biggest event even arrives. Because the real stress test isn't behind us. It's on the calendar. What happens when those loans come due? This is the moment the timeline turns into a trigger. Fact. Between March and December of 2026, roughly $936 billion in commercial real estate loans reach maturity. These aren't amortizing loans that slowly pay down. They're balloon loans. 5-year and 10-year deals written when interest rates were 1% to 3% and property values were at their peak. When those loans come due, borrowers have only 3 options. Fact. Option 1, pay the loan off in full. Most can't. The cash doesn't exist. Option 2, refinance. But refinancing requires the property to appraise high enough to support a new loan. And today, many properties are appraising 20 to 40% below their 2021 values. That creates an equity gap borrowers have to fill with cash they don't have. Option 3, default. Hand the keys to the bank, walk away. This isn't emotional, it's mechanical, and it's already happening. Fact. If just 30% of those maturing loans default, that's more than $280 billion in fresh losses arriving in less than a year. Those losses don't spread out over time. They hit when the loans mature. Here's where control disappears. These defaults don't wait for permission. They don't wait for regulators. They hit balance sheets on preset dates. This is why it's called the maturity wall. It's not a metaphor, it's a schedule. And once that wall is hit, the system doesn't get to choose how fast the damage spreads, because the next force doesn't come from balance sheets at all. It comes from people. This is where it stops being abstract and starts touching real lives. Fact. When banks come under stress, the first reaction isn't collapse, it's withdrawal. They stop lending, credit lines shrink, refinancing gets denied, projects stall. That happens long before a single bank branch closes. Now shift this to you. If you run a business, this is what it looks like. Your credit renewal gets delayed, your loan officer stops returning calls, payroll credit tightens, expansion plans freeze, not because your business failed, but because your bank can't take more risk. If you're an employee, this shows up as layoffs that don't make sense yet. Construction projects pause, contractors get cut loose, commercial tenants shut locations. These aren't political decisions, they're cash flow decisions. Fact. When regional banks pull back, local economies feel it first. Regional banks fund small businesses, apartment construction, retail centers, medical offices. When that lending slows, entire communities slow with it. Now, here's the detail most people miss. Even insured deposits don't always move smoothly in a failure. When a bank is seized on a Friday night, systems can freeze. Debit cards go offline. Online access pauses. It's usually temporary, but temporary is all it takes to cause panic. This is why fear matters more than fundamentals in moments like this. If this feels familiar, say so in the comments. Because once fear enters the system, it doesn't stay contained to the banks with bad balance sheets. It spreads, and the mechanism that allows that spread is already in place. Here's the part that mainstream coverage almost never explains clearly. This doesn't spiral because everyone suddenly makes bad decisions. It spirals because the system is built on confidence, leverage, and timing, and all three break at once. Fact: banks don't fail when losses exist. They fail when losses become visible and confidence disappears. A bank with weak assets can survive for years if depositors stay calm. The moment depositors move, the math collapses in days. That's the mechanism. Deposits fund loans, loans fund assets, assets support confidence, confidence keeps deposits in place. Break that loop anywhere and the system feeds on itself. Fact. In 2023, one bank failure triggered another that didn't share the same problems. Not because the second bank was insolvent at first, but because depositors assumed it might be next. That assumption alone was enough to kill it. Now connect that to today. Fact. Nearly 1,800 U.S. banks have commercial real estate exposure exceeding 300% of their equity capital, the regulatory threshold for high risk. Hundreds are far beyond that. Those banks don't need fraud to fail. They just need a reason for depositors to hesitate. And here's the unsettling insight. The system doesn't collapse from the biggest banks outward. It collapses from the middle. Large institutions are assumed to be protected. Small banks fail quietly. Regional banks sit in between, big enough to matter, small enough to panic over. That's where pressure concentrates. And once a few of those banks tip, the next move isn't made by regulators or executives. It's made by millions of depositors asking the same question at the same time. Is my bank next? Now look forward, not years, months. There are two paths from here, and both are already forming. Fact. If failures stay isolated, regulators can step in quietly. Weekend seizures, forced mergers, emergency liquidity facilities with bland names. The system limps forward, weaker but intact. Credit slows, growth fades, the damage spreads quietly through jobs, construction, and investment returns. But there's another path. Fact. If several regional banks fail close together, the same weekend, the same month, perception flips. Depositors stop waiting for reassurance. Money moves preemptively. Regional banks are forced to sell assets to raise cash. Selling turns hidden losses into real ones. Real losses trigger more withdrawals. This is where the story accelerates. Because once deposits start moving at digital speed, no spreadsheet can keep up. Decisions that used to take quarters get made in hours. Regulators don't get to choose the tempo. Markets do. Here's the detail that changes everything. The deposit insurance system isn't built for speed or scale. It works when failures are rare and isolated. It strains when dozens appear. It breaks when hundreds are even suspected. So the next phase isn't about whether the losses exist. They do. It's about whether confidence holds long enough to manage them. And confidence is already thinning. You can feel it in earnings calls, in tighter lending standards, in the way risk managers talk when cameras are off. The next move is already forming. And the moment it becomes visible, there won't be time to debate what it means. Here's the insight that ties all of this together. Fact. This isn't a story about banks making reckless bets in secret. It's a story about a system that functioned only as long as time, confidence, and low interest rates stayed perfectly aligned. When rates rose, time ran out. When time ran out, confidence cracked. The filing in Charlotte didn't start the collapse. It proved that the collapse no longer needs a trigger. The math is already doing the work. In past crises, people waited for headlines to tell them something was wrong. This time, the warning signs live in regulatory filings, refinancing calendars, and balance sheets that only work if nothing moves. But things are moving, slowly at first, then all at once. The uncomfortable truth is this: systems like this don't end with a single dramatic moment. They end with a series of quiet realizations followed by sudden reactions. By the time everyone agrees on what's happening, the options are gone. That's why this story doesn't end here. The next phase won't be announced. It will be inferred from which banks merge, which loans fail to refinance, which markets freeze first. This isn't about panic, it's about awareness, because the people who understand the mechanics early don't need to rush later. If you want to follow how this unfolds step by step, as the signals appear, that's what this channel is for.